Stock markets this year have definitely been a roller coaster, but Justwealth has its own pilot, so to speak. And James Gauthier is going to join us right after this word from our sponsor. James, great to see you again.
All right, Pat, always great to be here.
March, stock markets around the world declined sharply. And then, kind of since the beginning of April, they've been recovering. And just this week, we find out that the tariffs have been listed. Tariffs cause things, I think, to go down. Tariffs are being adjusted with China. Is it all about the tariffs? What do you think is going on?
Yeah, there's a lot of news coming out, and it seems to be offsetting news most of the time. So it's getting hard to keep track of, and sentiment is changing along with the tone of the headlines that are coming out. So tariffs going on, that's bad. Investors react in a negative way. Tariffs are being reversed. That's positive news. Investors react immediately in a positive way. Net net, the stock market is basically exactly where it was when all of this started.
Yeah, it's amazing how that worked. How about interest rates? Because you're going to get the central banks around the world, not just in the United States, responding to some of the pressures they're seeing. Is that happening in interest rates as well?
Well, I mean, each independent central bank is going to be making decisions based on their own relevant economies. So the Bank of Canada is going to act independently of the U.S. Federal Reserve, the ECB, Bank of England. All these different banks are going to take a look at their own economy and focus on their own mandate, which is to keep price stability for most of them. The U.S. has a dual mandate to also look at employment and try and encourage full employment at the same time as price stability. So their mandate is more complicated, but everybody else is just looking at price stability within their own region. And there are different, interest rate, inflationary pressures in different economies. So overall, we're seeing a net easing, but it's I would say stable at the moment, waiting to see further weakness, which hasn't materialized yet.
Against that background, what does all this tell you about the actual economy? And let's just focus on the States for the time being, and then we'll get to Canada later on.
So the U.S. economy, it is interesting. We're getting a lot of data that is making people scratch their heads a little bit. So the last U.S. GDP read was negative, which is contrary to the labor force data, which is coming out quite strong. But it's a bit of an anomaly, and even though it was worse than economists' expectations, the problem was a surge in imports that happened in the first quarter of 2025. When imports go up, that's actually a drag on GDP. But because of the tariffs coming on, a lot of companies were stockpiling in advance of the tariffs. So they tried to front run the tariffs a little bit, built up their inventories, and that increased imports, which decreased GDP. So although it was a weak reading, it's kind of a false weak reading. The labor data, which the US, at least the Federal Reserve looks at a little more closely, is still quite strong. Inflation is still persistent or stubbornly high. So from that viewpoint, the economy in the U.S. has not really seen negative impacts yet from the tariffs coming on.
Well, interesting. So the tariffs have people importing more and the GDP is affected. Is the opposite true? In other words, if the tariffs are being lifted or if the shipments have slowed down, will GDP bounce back more than it should or could?
Yeah, that's the expectation. So the surge in advance is going to mean a decrease in imports, basically effective whenever the tariffs, and again, the tariffs have been a moving target at best. So it's hard to predict when that exactly is going to come through in the data. But if you figure that the surge came before basically the end of March, it's going to slow down after that. So depending on what the rest of the economy does, I mean, the imports and exports or net exports as it's measured in GDP is just a fraction of the overall GDP. Consumer spending, business investment, government spending, they all affect it as well. So it's more than just one variable when you look at GDP.
Fair, but we're getting job growth. We're getting an economy that, or the GDP that's going to potentially bounce back. What does that do for you when you're managing your markets? Are you looking to buy now in the United States?
No, I mean, we take a longer term. We're not worried about the current quarter's GDP or the last quarter's GDP or even the next year's GDP. We're concerned about GDP trends over the next 10 years. What are the growth rates going to be like? What will that affect? The growth rates expected to come through in the stock market. What is that going to do to interest rates over time? How's that going to affect bond prices? So we look at long-term trends. So any short-term ticks we don't get too concerned about, but we do worry about the long run. And some of the impacts of tariffs are probably going to be a bit negative in terms of longer term growth rates. So I would say overall, what's been happening early this year is modestly negative, but nothing that's going to change how we manage the portfolios.
Okay, let's turn our attention to Canada now. And we've obviously had an election. Did that affect the stock market?
Well, it removes some uncertainty, I guess. Anytime you have an election, there's uncertainty as to who's going to win. Early on in the polls, at least, shortly after Trudeau resigned, conservatives were favored to win the election. That sentiment did change leading up to the election, and they were predicting a liberal majority win after they announced Mark Carney as the successor. They didn't get the majority. They came very, very close. But I think it did remove some uncertainty. So the election's out of the way. I would say that, the election is a secondary issue at the moment. It's still the tariffs and the overall sentiment emanating from the US that is affecting all of the other stock markets in the world because they're so highly correlated. Anytime the news comes out of the US, that's more influential than anything that comes out of Canada applies to our own stock market, which is kind of hard to believe, but it's the truth.
Okay, but if you're sounding a little bullish on the American economy and potentially, I guess, longer term in the stock market. Are you looking at Canadian stocks as well then?
Well, I mean, we have kind of set rates of what we expect to hold in terms of equities in our portfolios. So,
Mm.
our high growth portfolio is always going to contain 80% equity. That's not going to change. What we could do is shift a little bit from Canada to US or US to international or any combination of those. We're not changing anything at the moment based on the current view. We've always kind of held that the US is the most attractive market, but there is a good reason for Canadian to own Canadian-based stocks, even though it's called sometimes the home country bias. There's a currency factor as well that makes it a good reason to have that in your portfolios. So our allocations or our planned allocations have not changed as a result of anything that's happened recently.
Wow, and that's true of all foreign markets then too?
Effectively, yeah. I mean, we've made some subtle adjustments, but I mean, these are ongoing portfolio adjustments that could happen anytime. If a market does particularly well for a while, we may take profits in that market a little bit, reallocate elsewhere. But that's normal course of business. Nothing that's been triggered by any events that are currently happening affecting markets.
Well, you and I are going to talk again in 2 months' time. I guess in the meantime, you're going to continue to watch tariffs?
Well, it's moving markets, so yeah, we have to at least be able to answer to clients, what is happening and probably why they shouldn't be concerned. We've had a lot of client calls recently, people nervous. Despite our newsletters coming out and saying this time is not different, people are coming back to me and saying, yes, this time it is different. No, it's not different. It's the same thing. There will be short-term turbulence. Everything will settle down. I mean, basically everything that we've put in the newsletters and our previous podcast that we did, it's all played out exactly as we would have expected. I would say a lot quicker than what we expected. I didn't think things would recover this quickly, but the news is moving pretty quickly and markets are reacting pretty quickly. And net, like I said at the beginning of the podcast, we're basically back where we started a few months ago.
Yeah. James, always great. See you in a couple months.
Okay, thanks, Pat.
James Gauthier, Chief Investment Officer at Justwealth.